is designed to help you understand how better to answer a budgeting question in Paper 2. To illustrate this, we're going to use the Cambridge paper from November 2016, Paper 2.2, Question 4. The question gives you some information for Rodriguez Limited. It's a manufacturing business producing two products, Product X and Product Y. The following budgeted information is available for the next month. You can see that over here they've shown you what the budgeted production is in units. So they are hoping to or wanting to produce 5,000 of product X and 7,000 units of product Y. Based on those production levels, these are what the costs would be per unit. So in other words, the total costs would be these figures times the number produced. Obviously, direct materials and direct labor are going to be your direct or prime costs and will relate to the 5,000 units. So they will get bigger or smaller in total, depending on whether that production level changes, as will the variable overheads. Remember that some overheads can actually fluctuate depending on how many units are produced, even though you can't allocate it directly to a particular item. The fixed overheads, however, will always stay the same. So whether 5,000 units are produced or 4,000 or 6,000, the overall cost would change. In other words, the fixed overhead cost per unit will decrease the more you make and will increase the less you make. So you can see here you've got figures given for X and for Y. We are then given some additional information. Both products are sold with a 20% markup on marginal cost. What does this mean? The marginal cost is referring to your variable costs. In other words, all those costs that will change if your production levels change. So the marginal cost will be your materials, your labor, and your variable overheads. So you will need to add those three figures together to get your marginal cost, and then you will add on a markup of 20% of that. Direct labor is paid at a rate of $4.60 per hour. So you can then see by looking at the total labor cost per unit, how many labor hours are needed to produce one unit. Do keep in mind that these are per unit costs, and then you would times it by the 5,000 units to get the total labor cost if you needed it. So let's see what is required. Firstly, we are required to calculate for each product the unit contribution in dollars. Contribution means how much can be contributed towards covering the fixed costs. In other words, you are looking for your marginal profit, but specifically per unit. In other words, your selling price per unit minus all these marginal costs per unit will give you your unit contribution. Now, in order to be able to do that, what we're going to do is, let me just move that a little bit out of the way. There we go. What we're going to do is we'll start off by working out this marginal cost or variable cost that we're talking about. So you add together your material cost for X of $12.50, labor for X of $18.40, and variable overheads of $9.10. And if you add all of those, you'll get a marginal cost of $40. In other words, for product X, there will always be a cost of $40 per unit, no matter how many you make. If you do the same for Y, you will see that you get a marginal or variable cost of $45. Once you know what the costs are, you can then work out what the selling price should be. We know that we want to add on a markup of 20% on top of this. So therefore, we'll take that 40, which is the marginal cost, and times it by 120%. You could just times 20% and then add it to the 40, but by adding in this 100% over here, it's simply a faster way of getting the answer that you are looking for, because it means that you are including that cost in your answer. So if I say 40 times 120%, in other words, times 100% for the cost and 20% for the markup, I will see that I would sell unit X at $48. Unit Y we can work out in the same way, the 45 marginal cost times the 120% to get 54 as the selling price for Y. Remember then that the contribution is the difference between the selling price and that marginal cost. So you can actually work it out in two ways. You can either work it out by saying 48 minus 40 gives you 8, or you can simply say, well, obviously the difference between these two is that 20% markup. So you could quite simply say the 40 times the 20% markup to give you 8. For Y, you can work it out in the same way, and you will see that your contribution is 9. However you decide to do your calculations, and as you can see there are a number of ways of doing them, do make sure that it's very clear to explain what you are doing so that if necessary you can get part marks along the way. And also identify very clearly what your answer actually is. So over here I've highlighted it in green. Now obviously you can't always highlight your answer in green, but you could just highlight it with a highlighting pen, or just make sure that it's the last thing you write and you show that the contribution is that, because you're looking for the contribution per unit. Right. You can then have a look at what is required for number 2. Number 2 asks you to calculate the total direct labor hours required to meet the budgeted production. In other words, in order to make 5,000 units of X and 7,000 units of Y, how many labor hours do you need? Remember that they have told us what the direct labor cost is, and we know what the cost per unit is, and we can now use that. If we have a look at X, you can see that the budgeted production for X is 5,000 and Y is 7,000. You don't need to write that, and I've just shown it here to help you understand how we are getting to the answer. The labor hours you can use, as I showed you, your total labor cost per unit divided by the labor cost given per hour, and you can then see that X needs 4 hours to make the product. So 4 hours times 5,000 units means that we need 20,000 labor hours to make X, and similarly for Y we need 42,000 labor hours, because the total direct cost per labor cost for Y was 2760, which means that we needed 6 hours, and so therefore 6 hours times the 7,000 budgeted production gives us the 42,000 hours. We can then add those two amounts together to find that our total labor hours that we need are 62,000. Let's now go and see what next we need to do. We are now given some additional information. The business only has a total of 59,000 direct labor hours available. Now immediately you can see that there's a problem. We want 62,000 hours, but we've only got 59,000 hours because we only have a certain number of employees, and those employees are only able to work a certain number of hours. We are then asked to calculate the maximum profit that can be achieved from the total direct labor hours available. In other words, with this 59,000 that you have, how much profit can you make as the absolute maximum? So we now need to decide what would we make of product X and what would we make of product Y. The first thing I'm going to do is try and see which of my products is actually going to be most profitable based on the labor hours. Remember that we saw that X has a contribution of 8 and Y has a contribution of 9. So if you just look at it at first glance, you might say, oh, we need to make more of Y because there's a higher contribution. However, have a look at the labor hours needed. We've already worked out that X only needs 4 hours and Y needs 6 hours. So if we have a look at this as a ratio, you can then see that the contribution of $8 to 4 hours means actually there's a contribution of $2 per hour that you use for product X, but product Y, you only get a contribution of $1.50 per labor hour. So therefore, X is actually making a much better contribution per labor hour, and so therefore we want to make more of X given the fact that our hours are limited. So what we'll now do is say for X, we'll use the full 20,000 hours that we want. We worked that out over here above by saying we needed 20 hours for X. So we will use those 20 hours. We use it for 5,000 units at a $8 contribution, means that there's going to be a total of $40,000 as my maximum contribution for unit X or product X. For product Y, we had 59,000 hours available, but now we are going to use 20,000 for X, which means that we need to make a little bit less of Y than we had originally planned, as we only have 39,000 hours now available. If we know that we need 6 hours per product and we have 39,000 hours available, it means that we can make 6,500 units of Y. At a contribution of $9 each means that Y's contribution overall will be $58,500. So my total marginal profit that is available to cover my fixed overheads is $98,500. My maximum profit, therefore, will be this marginal contribution minus the fixed costs. Given the direct costs that were given to us, sorry, it won't be over there. Let's have a look over here quickly. If you go back to the beginning, you can see that your fixed overheads were given to you as a cost per unit. So we can take that 575 times the 5,000 units of X to get a total fixed cost for X of 28,750. Our fixed costs for Y, we will work out similarly using the $4.80. Sorry, this over here should be written as $4.80, not 4,800, forgive me. And that will then work out as your total costs that you need, times 7,000 units. Now, please be very, very careful over here. You need to use the 7,000 units, not the 6,500. And the reason for this is quite simply the fact that although you are only going to make 6,500 units, your fixed overhead cost is not actually going to change. Although it's been worked out here as $4.80, that is assuming there are 7,000 units produced. And even if there are less made, the fixed cost will overall stay exactly the same. So, working backwards now, we can work out that the fixed costs for Y should have been 33,600. And if we now take that into account, so we say our overall profit minus the fixed costs for X and the fixed costs for Y, we then arrive at an amount of 36,150 as the maximum possible profit that can be made. Let's now have a look at C. Question C asks us or gives us an interesting scenario. It tells us that there are actually two options available in order to meet the budget that we are wanting to meet. The first option is to pay the existing staff overtime. This would be paid at a rate of $5.75 per hour instead of the $4.60 that was previously quoted. Option 2 is instead of paying the staff overtime, we could buy the existing products from an external supplier, in other words, from one of our competitors, at a cost of $50 per unit. Which of these options would then be the most profitable to achieve our budgeted production that we need to meet our required sales? So what we are asked to do for number 1 is to evaluate the options available to achieve the budgeted production, and we need to discuss the pros and cons of each and back it up with calculations. And we'll do that for both option 1 and option 2. And then number 2 asks us to recommend which option we should choose and why. It's very important here to justify your answer always. So let's go and have a look again at the information that's given and see what we can do with it. Option 1. For option 1, you hopefully will remember that there's an extra 3,000 hours that are needed. Remember that for Y, we want to make 7,000 units, which requires 42,000 labor hours, but in this calculation we only are allocating 39,000 hours. So the difference between that is 3,000 hours that I actually need. Or you could look and say the 62,000 total needed minus the 59,000 that is available means 3,000 labor hours are required. Now, if I employ staff at $5.75 instead of the $4.60 to make the extra 500 units of Y that we need, my extra labor cost is going to be the difference of $1.15. That is the extra overtime rate that I have to pay, times 6 hours, because remember that we're working on Y here, because X was the most profitable to make at the rates that we were given and the hours that were available. So we're going to make an extra 500 units of Y, which needs 6 hours per unit. So $1.15 extra times the 6 hours per unit means that there's going to be an extra cost of $6.90 per unit. I need an extra 500 units, which is the difference between the budgeted 7,000 and the 6,500 that I'm able to make. And if I times this by the extra cost or the extra contribution, remember here, now what I'm doing here is I'm saying the $9 is the contribution that each product Y is able to make towards my fixed costs. But I have an extra cost of $6.90, which means I now only have a contribution of $2.10 for each unit. And if I times that by the 500 units that I need to make, it means that my overall costs will increase by 1,050. Or sorry, my contribution will be 1,050 because my cost is going to increase by this much. Okay, so my contribution is much smaller than what it was initially, because initially I had a contribution of $9 per unit, but now every extra 500 that I make, I've only got $2.10 to contribute. So my overall contribution is only going to be 1,050 extra. Since my fixed costs won't change, as we discussed in B, it's not going to affect the profit. So the profit would actually increase by the total of this extra contribution. So I need to factor that in. That's what my profit would increase by. If, however, I buy the goods in, which is option 2, my selling price isn't going to change. You can't sell some of the units at one price and some of the units at another price if it's all going to one customer, for example. So you've got to keep your selling price exactly the same. And the cost is now $50. That means that there's $4 for each item, which means that your profit would actually increase by $2,000, which is a whole lot more. Alternatively, you could look at the costs per unit and see which one costs less. As we worked out above, you can see the original cost was $45 per unit, but then you add $6.90, which is this calculation here that we worked out per unit, and work out that each product is actually going to cost $51.90 instead of $50 for those extra units. And as a result, you can see that option 2 is certainly going to be more cost effective. So we do want to make sure that we are being more cost effective, but there are other things that we need to consider as well. And you need to show this in your explanation as part of your evaluation, because it's not only costs that you want to look at. Option 2 is certainly nicer based on costs. However, option 1, by making it yourself, it means you're able to maintain your quality and your reputation. You can vouch for the goods that you actually make instead of having outsourced products that maybe you can't rely on quite as much. In addition, if your workers are working overtime, you might find that they get overly tired, and therefore the quality might actually drop if they are not able to produce at exactly the same pace and quality as they were before. The nice thing over here, however, is that there are no delivery implications. You don't have to worry about will the supplier bring the goods in time or not. You simply know. You are making the product and you are simply relying on yourself. So although the profit increases, the cost, the fact that it's higher than outsourcing, means the profit will be less than the profit from outsourcing. And you might also find that your staff don't want to work overtime, which could be problematic. It's all very well saying you'll pay them more, but they might say it's not worth it. I would rather go home. Option 2, you've got to be very careful about your supplier, the reliability and the delivery. Will you have the goods in time? Will the quality of those goods be up to standard or not? There is a higher risk relating to the delivery and the quality, but you can make more profit if you go with option 2. However, you also need to factor in staff might be upset. They might be concerned by the fact that you are buying in products from the competitor rather than just using them, and they might not like this idea. You also have to consider the fact that you are losing part of the market to your competitor who you are buying from. So you need to consider all of these things and then make your choice. Now, if you are only looking at costs, obviously you would want to choose option 2. However, you also need to factor in quality, reliability, staff morale, etc. And this allows you to choose option 1 if you think that this would be a better idea. Obviously, you would need to have a little bit more information at your disposal about the reliability of the suppliers and your staff, etc. But for number 2, you need to choose either option and make sure that you justify it. In other words, explain your answer, refer back to some of this, and say why you think your option would be the most suitable. Moving on then to D. This is now just going into a little bit of theory. You don't have to think quite so hard. 3 advantages of budgetary control are simply going to be things like it helps you to plan for the future, it helps you to monitor the performance because you're able to compare what did you budget versus what were the actual costs. When you identify the difference between these two, you can then go and take corrective action to try and get your business back on track. You're able to delegate certain decisions and cost adjustments to the different departments and make them responsible for what they are spending. It helps you with your decision making and deciding what course of action you need to take. It also helps with responsibility accounting, or making sure that the managers are able to actually take responsibility for their own departments and you're able to assess them accordingly. It can also motivate staff. However, for number 2, you need to identify 3 disadvantages of your budgets, and you need to then weigh up the disadvantages against the advantages to see whether it's worthwhile doing or not. Your disadvantages of budgeting are that budgets are an estimate. they might be wrong. You need to consider what base you were using to create those budgeted figures and how realistic they are. Budgets are also very time consuming to create and therefore expensive and costly. And you also want to monitor them, otherwise it's pointless doing them. You might also find that although they can motivate staff, the opposite is also true. They might demotivate employees if the budgets control the spending too much, that suddenly staff feel that they're not able to do what they need to do. You might also need to employ specialist staff to create and monitor the budgets, which may end up offsetting the costs that you might otherwise save. If the budget is unrealistic, it's not going to be useful at all. It doesn't account for unforeseen circumstances. Yes, it is possible to try and look ahead as far as you can, but every so often something will happen that you could not have expected, and then your budget is going to be turned on its head. In this case, it's very important that you actually relook at the budget and rebudget as quickly as possible. And linked to the idea that your budget might be unrealistic and you could demotivate employees, it can also restrict staff innovation. It means that your staff aren't necessarily able to be as creative and innovative as they might otherwise like. I certainly hope that this helped you understand your budgeting a little bit better. Maybe go